I have two really interesting articles with regards to the favorite stock of this channel, which is Alibaba. So I'll provide my real-time reaction to it. I skimmed through it a little, but I haven't really do my deep dive. So I'll be sharing my thought process in real time. And the two articles, they have very enticing headline. The first one is, I was wrong about Alibaba, but here's why I still own it. Bracket, rating downgrade. And the second one, of course, is our most favorite Seeking Alpha author, which is Mr. Bo here. He said that Alibaba, this will not end well. So I think before I jump right into it, I just wanted to make a public service announcement. In case you guys have missed out this community post, I actually posted this on the 1st of Jan. Essentially, I'm running a mini competition, taking in all your price predictions for Alibaba on the New York Stock Exchange for the end of this year. So you can submit your price prediction in this Airtable form. Once you click into it, you will know what you should feel and should not feel. And the deadline for submission is the end of this month. So do feel free to check it out. And also, for those of you who have been interested in getting a Seeking Alpha subscription, the two articles that I'll be reacting to will be authors from Seeking Alpha. They're currently running a crazy amount of discount. I think it's kind of a flash sale at the end of the year. It's going to expire soon. If I'm not wrong, it's on the 10th of January this year. So for the first year, you actually get like 83% discount. It's only $39. So if you're interested, you want to test out the platform, usually they give some sort of an earnings review. They have a lot of analyst estimates, and of course, they have a lot of this kind of articles from independent authors. So likewise, you'll be supporting the independent authors. And if you use my affiliate link in the description box down below, you are kind of supporting me as well. So for those of you who have been waiting on the sidelines, wanting to get a Seeking Alpha subscription, do head into the link to check it out. If not, let's get right into the two very juicy articles. So it's written by this guy called The Asian Investor. He didn't provide his name, but if you have to look at his profile, he said that I look for high risk, high reward situation. 5 largest portfolio holdings: AMD, Micron, Alibaba, Ethereum, and PayPal. Early buyer of cryptocurrencies. I live in Thailand. Great. So let's look at how or what he has to say in this article specifically. So for the summary of this article, Alibaba Group has obviously been a terrible investment in 2022, with the stock price declining 23% year to date. I'm not too sure whether I would say 23% year to date is bad per se, especially for those of you who have been buying the dip. I think some of you are even green in the Discord chat, so I wouldn't necessarily say that everybody's deep in the red, but personally, I'm still underwater. So for those of you who are stuck back holding, don't worry, I'm in the same position. So while Alibaba's e-commerce business slowed down drastically this year, growth in other segments could play a stronger role for the company in FY 2023 and beyond. A general reopening could revive Alibaba's e-commerce business, and the cloud segment especially is promising. So shares of Alibaba has been revalued 23% lower, and he said that including himself, he started to recommend Alibaba at a significantly higher valuation at around 160. I'm owning up to my mistakes I made in the last year. However, I'm also going to take a look at Alibaba's potential in FY 2023. And I think just to rewind back time, I would like to own up to my mistakes as well. If you to go through my first video that I posted on my own channel, you can see that I posted my first video in 10th April 2021. 2021, that's 2 years ago, or close to 2 years ago. And I did say that, no, 20 to 25% of my position is in Alibaba, so I might be biased. Lol. And I think at the time of this recording, that was when Charlie Munger first entered. I think he entered at sub 200, around the $200 level, or 180, 190. So I even started recommending Alibaba even earlier than Mr. Asian Investor here. But of course, everything that we say on the internet, we like to say that it's not financial advice, you shouldn't follow us, but I know many of you still did follow. But I think for those of you who have been following my calls and averaging down alongside, your average price wouldn't be too high as well. But yes, I've been catching this falling knife for close to 2 years now. So my mistakes in 2022. Obviously, with Alibaba share revaluing to the downside and losing about a quarter of their value in 2022, it is hard to defend my call to invest money into the Chinese e-commerce company at the end of last year in Alibaba, a top turnaround stock for 2022. A couple of factors weighed on Alibaba's business performance as well as investor sentiment in the year, including unprecedented large-scale COVID-19 lockdowns across China, a slowdown in Alibaba's e-commerce business, which was partially offset by accelerating growth in local consumer services, continual fear about increasing involvement of authorities, the risk of delisting after the SEC warned, general market concerns over a post-pandemic market slowdown, high inflation on consumer spending, and Alibaba's top-line growth slowing to 0% in the June quarter. I think, of course, we can say that in hindsight, many of these concerns are unprecedented, and it's in hindsight we look back and we realize that Alibaba trading at a sub $80 valuation, around the 60-ish valuation, it might have been warranted. But I think many of these fears, especially when you bake in a lot of these concerns, right? When there's an earnings slowdown, you mix in geopolitics, you can throw all the fundamentals out of the window. So many a times we don't really know what is essentially driving the sentiments around the stock. Was it really fear of politics, or is it fear of the fundamentals? So in this case, I would actually give the credit to a lot of all these technical analysis people out there saying that, you guys shouldn't catch a falling knife. You don't know what will happen. And essentially, the market is trying to quote unquote price in many of these bad news per se. So, but that said, I think personally, as an investor that has a very long time frame, I have time on my side. I'm not trying to come in and out and try to punt for a 10-20% recovery, and after I make that 10-20%, I'm gonna find the next investment opportunity. I don't think so. So at least that's not my investment style. And you can see that I've managed to kind of catch the falling knife or caught the bottom for Tencent specifically. And right now, I think I'm up around 30% on my Tencent position. So many friends also texted me, hey Chiging, I saw your recent portfolio update. And for those of you who haven't checked it out, I'll leave the link somewhere here, or the thumbnail somewhere here. You can check it out. They were saying, I saw your video. Are you going to sell 30% gains? You can lock in like a 3,000 USD gain. That's pretty significant, right? You can move or redeploy the capital to some even undervalued names. Personally, for me, how I look at it is quite simple, because investing is always risk reward, right? Even after this recent recovery, after the October lows of many of these Chinese tech names, I still think that they're severely undervalued based on my own calculations of the intrinsic value, the quality of the business, the quality of management. So even at a 30% green, I wouldn't be selling out of Tencent. Why would I do it? If based on my own calculations, I think Tencent is worth at least 400, 450 or 500. Why would I sell at 300 plus? I mean, that's my perspective. And similarly for Alibaba, I do have a lot of price targets put forth in my channel. I'm looking Alibaba easily a 2x, 3x from here in a few years' time. So why am I worried? I don't exactly know. And if I really do take into account, you shouldn't catch the falling knife, or you should wait for a technical reversal and stuff like that, I'm not too sure many of my trading friends out there, for those of you who have been monitoring Chinese tech stocks, are you guys even in the position right now? Do you guys have a long position, a short position? I don't know what you guys are doing. So do you guys manage to catch the bottom? And if not, when are you waiting to deploy your capital? Or are you still waiting for something to happen and for the stock price to collapse? Or are you just waiting and don't want to bother chasing this Chinese tech boat and want to deploy your capital elsewhere? I think this has been my biggest concern, or basically the overhang above me when thinking of it from a trading perspective. So when am I going to enter? If it's a falling knife, I won't enter. Now when it rebounded at least 30 to 40%, some of my trading friends say that, it's too high. It's bound for a correction. So it seems like none of them actually enter any position at all. So that's that. I think you have to be discerning of your own investment strategy, whether you're an investor or you're a trader. So I'll leave it to you to decide. Now, because of all these reasons, Alibaba drastically underperformed my expectations in 2022, as I clearly misjudged Alibaba's upside and underestimated the company's downward revaluation potential. However, not all is bad. While Alibaba underperformed, I believe a general reopening of the Chinese economy could reboot Alibaba's e-commerce business in 2023, and the cloud business makes Alibaba attractive in the long term as well. And I totally agree. China's economy is set to reopen. Alibaba's revenue growth dropped to zero in the June quarter due to the widespread lockdowns, which had a chilling effect on consumer demand. However, a reopening of Chinese economy, which is expected in the short term, could be a powerful catalyst to unleash pent-up demand for Alibaba's struggling e-commerce business. Firstly, I don't think Alibaba's e-commerce business is struggling per se. By struggling, I would presume that growth rates would be like a negative 10, 15, 20%. But I mean, they managed to hold top line revenue growth steady year on year. And there, because of the big conglomerate Alibaba there is a lot of moving parts. But I think for the advertising revenue specifically, which is the customer management revenue, yes, it's down 7% year on year. But if I take into account the overall context of China, I don't think Alibaba is performing adversely compared to its competitor. And one of the closest competitor in the advertising space is actually WeChat, or Tencent's advertising business. And you can look it up. Tencent hasn't been having a very good time either. So all things considered, I think given the context, it's still fine. So Alibaba's potential in 2023 and beyond, which is cloud. So AWS is the uncontested leader in the cloud business with a market share of 34%. The second largest player is Microsoft Azure with a share of 21%. The third largest is Alphabet. So Alibaba is only the fourth largest company with a market share of 5%. But I believe the Chinese e-commerce company has potential to grow its market penetration as well as deliver strong revenue growth if it's growing business going forward. So based on McKinsey's report, China's public cloud market is expected to triple in size from 32 billion in 2021 to 90 billion in 2025. And I think similarly, Alibaba themselves has provided some sort of guidance. I think Alibaba did provide a guidance of around $200 billion renminbi in 2020 to a $1 trillion renminbi in 2025. So if we were to take into account 1 trillion, the exchange rate is around 1 is to 0.14. So that's around 140 billion US dollars in 2025. And that's, of course, a very tall order, much higher than what McKinsey is projecting here. But let's say we take the conservative estimates of $90 billion. Let's say the total addressable market is, the TAM is 90 billion. So Alibaba right now, I think it holds around a 20 to 25% market share. So let's assume that just a 20% top line, 20% market share, they will keep losing market share to many of its competitors. A 20% market share on a $90 billion TAM, that's around $18 billion give or take. So $18 billion, this is USD by the way. They did report around a $20 billion RMB in the latest quarter. So if we take 20 billion and then we multiply it by 4, that's 80 billion RMB. So 80 billion RMB is around a 11.5 billion US dollar run rate. So that's a 56% growth from here. A 56% growth potential out into 2025. That's 3 years from now, 2023, 2024, 2025. So a 3-year CAGR, you add up to 50 odd percent. I think that's pretty impressive growth. And let's not forget that for the Chinese market, they are probably gonna monopolize the Chinese market as well. US companies like AWS, Microsoft Azure, Google Cloud, they can probably forget about going to the Chinese market. But that said, on a similar note, the Chinese cloud providers like Ali Cloud, Tencent Cloud, they can also forget about penetrating into the US market. Maybe for Asian market, the Southeast Asia market, I know there are quite a few Southeast Asian companies do use like Ali Cloud, for example, as their provider. But I think largely speaking, it's pretty polarizing and pretty siloed markets. So just keep that at the back of your mind. So Alibaba's cloud segment is now the second largest business regarding revenue contribution and is even bigger than the local consumer services and Cainiao, which is Alibaba's integrated smart logistics enterprise. So it is now the second most profitable segment based on the EBITDA margins. So given a strong forecast of the cloud market growth, Ali Cloud is set to increase its penetration into the market in the long term, while a reboot of the economic activity after the devastating lockdowns of 2022 could also be a catalyst for Alibaba's short-term growth. And one thing I would like to point out, currently Ali Cloud's EBITDA margin is around 2%. And 2%, if it just means that they're not mature enough and there is more R&D and a lot more pace that they need to catch up compared to like their AWS counterparts. And I think for AWS, their margins are probably around the north of 20 to 30%. So that is what a matured cloud provider should provide. And now it's still early. Ali Cloud is still early in the game. So how investors see Alibaba's valuations largely depend on their attitude towards risk. Some investors don't like to invest in Chinese companies given the uncertainty about the regulatory environment and the potential for political interference. Based off earnings, however, shares of Alibaba don't seem to be overvalued. Shares are trading at a PE of around 10.6 times, which is slightly below the 1-year average PE ratio of 12.12 times. So look how far we've come. The average PE ratio of Alibaba is at 12.2 times. And some people might think that this is some boomer company, but I really don't know. A tech company trading at 12.2 times. I guess the China risk is pretty intense and there's quite a bit of premium being baked into the current valuations. Let's not forget that when Alibaba IPO'd back in 2014, 2015, 2016, valuations were sky high. It was crazy. I think PE ratios were at least 30 or 40. But that was also when it was a growth company. But I'm just saying that many of these so-called political concerns and how Chairman Xi is gonna kill all these enterprises, those were not concerns like 5-10 years ago. but clearly it's one of the major concerns today. So surprise, surprise. Now, for the biggest risk for Alibaba in 2023 is that the e-commerce business will continue to be a drag on the firm's financial performance. But considering that China is planning a broad reopening of its economy, the e-commerce business may do unexpectedly well next year. This paragraph doesn't mean anything. He's basically trying to hedge his downside. It might be good, it might be bad, so it doesn't tell you anything. The regulatory landscape also poses a challenge to the company, and its investors as Beijing could interfere with Alibaba's business at any time, and it has shown a willingness to do so in the past. So this has always been an overhang around many of these Chinese companies because you're operating in a regime like that. So when you are in a very stronger held regime, things are quite unexpected. So many people will say that, oh, the risk is not worth the reward, or not worth the price. But I think I'll leave it up to you to decide. There is probably a price for everything. If not, what do you think the stock market is currently trying to do? Anyway, final thoughts. 2022 was another terrible year for Alibaba, and my call to buy the Chinese e-commerce retailer was clearly wrong and came at the wrong time. Me too, but if you guys caught the bottom, then kudos to you. Due to a variety of factors, most notably a slowdown in Chinese e-commerce sales due to the lockdowns, so Alibaba's top-line growth slowed to 0 in the June quarter, which I did not foresee. So while there are still challenges going forward, I believe it would be a mistake to write off Alibaba as uninvestable for either political or economic reasons. To me, I share similar sentiments. But that said, I think even for the December quarter, Alibaba might report pretty weak earnings. But moving into 2023, when we go into the Q4, Q1, Q2 updates, I think we will see pretty strong rebound. Now, going back to Mr. Bo, I think for those of you who have been loyal viewers of my channel, this is not the first time you see Mr. Bo. So just some disclaimer, Mr. Bo has been shouting for shorting Alibaba or saying that Alibaba is not a buy since I don't know when. Actually, no, he didn't say Alibaba is not a buy. He just gave Alibaba a whole rating all the way since October last year. Yes. Since the party congress, he's basically just telling people to ho, if I'm not wrong. Let me do some stalking. So essentially, since December of 2021, he has been saying that Alibaba is a ho. It's all yellow. So he actually didn't say it's a sell or a strong sell rating anyway, but he claims that he has been giving up crazy amount of predictions and saying that Alibaba has not been a buy for a very long time. But clearly, it's not. He just tells people to hold the stock. So by giving a whole rating, you're basically not making a position because you're not saying that it's a long or a short. So I'm not going to treat your recommendation seriously anyway. But I think we still need to take into account his arguments because let's not try to discredit the author here. So Alibaba's business continues to be negatively affected by the direct and indirect interference of Beijing in its affairs. The company is unlikely to aggressively scale its cloud offering in comparison to its Western peers. At this stage, it's safe to assume that Alibaba could become the biggest casualty of the ongoing US-China relationship, confrontation, whatever you call it. And that's his plug again. So in the last couple of weeks, Alibaba shares has slightly appreciated on the news that Beijing would ease its COVID policy, which recently caused Chinese citizens to protest against the government. Yeah, sure. While this is certainly a positive development of the company, its effects is likely to be short-lived as some of the fundamental risks that are associated with Alibaba remain and could materialize at any moment. Let's see what are some of these short-term fundamental risks that could materialize. So the first one, he says that the cloud business is still continually under pressure. So the current article actually focuses on highlighting the recent results of Alibaba's cloud computing business, which accounts for 10% of their total revenue. So if you go through their entire recent earnings report again, we'll see that the company's cloud computing business has grown by only 4% year-on-year in the latest quarter. For comparison, a year ago, Alibaba's cloud business has grown 33% year-on-year. So this nearly flat year-on-year growth rate of Alibaba's cloud business in recent months indicates that Beijing's domestic policy continues to play a decisive role in defining the level of success that Chinese companies could achieve. Interesting. So his biggest argument is basically saying that they pass a series of different data security laws, and he even followed up saying that some of the locally controlled companies were asked to migrate to state-backed cloud providers. But I guess his reporting only based on Bloomberg's report. He doesn't provide with any sort of commentaries with regards to which companies and would it also affect all the private enterprises or was this one-off? And like he said, it's in April. So compared to April, it has been a good 8 months or so. and I haven't really been seeing any greater developments from then on. But we'll see. But based on my own understanding of how I read the entire Chinese economy today, and based on Alibaba's own reporting from their management, they did see a huge amount of take rate from non-internet companies, but it also takes time because many of these are considered legacy firms with pretty dinosaur culture, so it takes time for them to adapt to cloud enterprises. And more importantly, because the entire Chinese economy has been experiencing a slowdown in 2022, so many businesses has also tightened their purse strings, and not a lot of them dare to make such aggressive expansion, especially expanding into something unknown. So those are at least my consideration. So I'll leave two sides of the coin for your own opinion. You make your own judgment on whether you believe the Chinese government is out there to kill many of these cloud enterprises like Mr. Bo asserts, or you agree to my own contextual understanding of what happened in China today. Now, moving on to the second point, he said that there's more downside to come. So in addition to domestic issues, Alibaba's cloud business also faced several external risks, which could limit the growth of its cloud offering. So just a few weeks after announcing its latest cloud computing system, powered by chips made by American firms, such as Intel and Nvidia, the US implemented the harshest export control rules that prohibit the exports of highly advanced chips into China, which put some of Alibaba's AI and cloud computing projects at risk. I would appreciate it if he can name the cloud computing projects and the AI projects that Alibaba is in though. But I do agree, I think this whole chip ban thing and chip export problem, it's going to be a huge headwind, particularly so for many of these tech companies. But it's not really an Alibaba specific problem. I think the entire tech sector in China, they are going to band together with the government to try to seek some sort of appraisal and to try to solve this problem. But in Chinese, there's this idiom called 狗急跳墙. When the dog, I mean, direct translation is when the dog is worried, dogs can even jump over walls. So if China is going to be backed up to this state, and the US is basically just forcing their hands. So the likely main reason why Alibaba cooperates with Beijing is simply that it has no other choice, and I do agree. But why would you be under the assumption that many of these huge conglomerates, private enterprises are not cooperating with the government? Why would companies not want to cooperate with the government? Wouldn't be bad if companies want to be in the good books of the government though, regardless of whether is it in China or whether is it in the US. I think for many of these US companies that are against the government, they are experiencing the wrath of the governments today. And even in Europe, I think they just instituted a windfall tax on some of these oil companies, and they're trying to repeal it. So I don't really understand why is it bad for companies to want to be in the good books of the government, but that's that. So he went on to talk about some military-civil fusion doctrine and yada yada. This is slightly conspiracy in nature, so I'm going to skip it. So Beijing is highly unlikely to revert its stance and allow the state companies to use the private cloud offerings anytime soon, if ever, limiting the growth opportunities for the business. So that brings us to another problem. Due to the closer cooperation of Alibaba with the Chinese military, there's a possibility that the US will finally pull the trigger and enforces the delisting of the company from the American exchange, which is something that is decided not to do more than a year ago. So in such a scenario, even a potential positive audit by the PCAOB wouldn't save the stock. We have already seen examples of when companies that are closely linked to the PLA, the People's Liberation Army, or the Chinese state, were added to the list of communist Chinese military companies, which prevented the US passport holders from owning or trading any stock of the business from that list. This is not really my concern. Most of my shares are in the Hong Kong exchange, so if they do delist, they delist. Let's not get too political, and let's not dive too much into all these external factors, right? At the end of the day, you just need to know there's only one thing that drives the stock performance: earnings, right? Earnings. Just know that if the fundamentals of the company is good, if they can keep printing more cash flow, keep printing more earnings, and if they're trading at dirt cheap valuation, you probably wouldn't do too badly. Unless the company just cease to exist and just go bankrupt or something. But yeah, let's put more focus on the earnings of the company and not all this delisting and yada yada and stuff like that. So the bottom line. So he added a DCF model which showed that the company's fair value would be $115.71 per share, and today Alibaba's trading near the $80 to $90 range. So the problem with the model is that it's based solely on the fundamentals. So while it shows that Alibaba is undervalued, we shouldn't forget that the stock has been trading at distress level for more than a year, while being undervalued solely due to the constant direct and indirect interference of Beijing in its affairs. So clearly, even a bear of Alibaba have a DCF model or have an intrinsic value calculation of 115. I'll leave it up to you to decide whether you want to listen more to the fundamentals and do your own calculations, crunch your own numbers, or you want to listen to things like, Alibaba might be closely linked to the People's Liberation of Army or the Chinese state, and that's why they'll be delisted. I think I greatly enjoy many of these discussions. If you guys want to see more of such reaction video, do feel free to leave in the comment section down below. And of course, don't forget to smash the like button. And with that, I'll see you in the next video. But more importantly, I will see you on the moon. Goodbye.